Ever looked at investing in gold and thought, nope, that's way out of my league?
Too expensive? Too complicated? Well, what if I told you that you can actually get started for less than the price of a movie ticket? Yeah, you heard that right. Let's dig in and see how.
No, seriously, just think about it for a second. For what you'd spend on popcorn and a drink at the movies, you could own a tiny piece of a real, honest-to-goodness gold bar. It sounds kind of wild, I know, but it is absolutely possible. And today, we're going to show you just how simple it is. Hey everyone, welcome to Wings of Wealth. Today, we are breaking down gold and silver ETFs. Our whole goal here is to show you one of the absolute easiest ways for a beginner to start owning precious metals, and to do it safely, affordably, and with total transparency. All right, let's get right into the practical stuff. This is where we're going to break down what a gold ETF actually is, and more importantly, how you can get started. It's all about taking that first small step, but thinking big about your financial future.
So what exactly is a gold ETF? Okay, picture this. A fund goes out and buys a massive amount of physical gold. We're talking big, heavy bars, and stores it all in a super secure vault. Then you can buy tiny electronic shares of that gold on the stock market. We call these units. So you get all the benefits of owning gold without any of the headache of, where to actually store a gold bar.
And here is the number that makes it all possible. 134 rupees. That's right around the average price of a movie ticket these days. For that much, you can buy your very first piece of gold through an ETF. It really is that accessible.
So how do you actually do it? Well, the process is incredibly simple. Step 1. You need a Demot and trading account. Think of it as your digital wallet for all your investments. Step 2. You just buy units of a gold ETF, just like you'd buy a stock. And that's it. Seriously, each unit you buy represents a fraction of real, physical gold that's being held securely and audited in bank vaults.
Okay, so you're probably wondering, how do they figure out the price for one of these units? It's something called the net asset value, or NAV for short, and it's actually pretty simple. They take the total value of all the physical gold the fund holds, which is based on a global benchmark price, then they subtract a tiny daily fee and divide all that by the total number of units out there. This whole thing gets updated every single day, so the price you see always reflects the latest price of gold.
Now, this is a really important point because it answers a question a lot of people have. Hey, why does this gold ETF seem so much cheaper than that one? It's not because the gold itself is cheaper. It all comes down to the size of the slice you're buying. Think about it. Some ETF units might represent a whole gram of gold, while others might represent just 1/10 of a gram. So naturally, the price for that smaller slice is going to be lower.
All right, so what happens when you want to sell? This is a huge deal. It's all about liquidity, which is just a fancy word for how easily you can get your cash back. And with an ETF, it's super easy. You can sell your units on the stock exchange anytime the market's open, and the cash is in your account the very next business day. There's no lock-in period, none of that. Just remember, you're getting cash, not a little gold bar in the mail. That's really just for the huge institutional investors.
Okay, let's talk about something you've probably seen advertised: digital gold. It sounds a lot like a gold ETF, right? But listen up, because there is a critical difference between the two, and as a new investor, this is something you absolutely need to know.
And here it is, straight from SEBI, the market regulator in India. This is a big deal, folks. It says digital gold is not a SEBI-regulated product. What does that mean for you? It means gold ETFs are a fully regulated financial product, giving you a layer of investor protection and oversight that you just do not get with the unregulated digital gold platforms.
Let's break this down side by side because it makes it crystal clear. With a gold ETF, it's regulated by SEBI. The pricing is transparent thanks to that daily NAV we talked about, and the fees are low and clearly stated. On the flip side, with digital gold, you're in an unregulated space. Extra charges for making or storage can be hidden in the price, and getting your money out isn't always as straightforward. For a beginner, the safety and transparency of an ETF really gives you that peace of mind.
Okay, let's talk about something that can really confuse new investors, so I want to clear it up. You might see the price of gold go up, but when you look at your ETF, it hasn't gone up by the exact same amount. First off, don't panic. This is totally normal, and understanding why is going to make you a much more confident investor.
So there are really three main reasons for this. First, there's something called tracking error. It's just a small, normal difference between the ETF's price and the actual price of gold. Second, remember those tiny expense ratios? They're deducted daily, so over time, they slightly reduce the returns. And finally, you have little market factors like how many people are buying or selling that can cause tiny price shifts. The key thing to remember is that these small differences are just part of how these things work.
All right, one last comparison to make sure you've got the whole picture. A lot of people hear ETF and mutual fund and kind of get them mixed up. They are similar, but the way you buy and sell them is totally different. So let's figure out which path might be right for you.
So the biggest difference is how you trade them. An ETF trades on the stock exchange all day long, just like the stock. Its price can change from 1 minute to the next. A mutual fund, on the other hand, you buy directly from the investment company, and its price only gets set once at the end of the day. ETFs also usually have lower fees, which is another big plus.
And it all comes down to the philosophy behind them. An ETF is what we call passive investing. Its goal isn't to be clever and beat the market. Its goal is to be the market. It just wants to perfectly copy the performance of gold. An active mutual fund has a manager who's actively trying to pick winners and beat the market, which is why it comes with higher fees and, of course, the risk that they don't actually succeed.
So let's wrap this all up. What are the big takeaways? Number 1, yes, you can absolutely start investing in gold for less than a movie ticket. Number 2, understanding little things like tracking error helps you invest with confidence and not worry. And 3, ETFs and mutual funds are just different tools for different jobs. But honestly, the most important thing, the time you're spending right now learning about how money works, that is the single best investment you will ever make.
Now, before we sign off, I want to leave you with this idea. Imagine owning a tiny slice of a massive shopping mall, or a busy office tower, or even a toll road, and getting a piece of the income they generate, all without having to buy the entire property yourself. Sounds pretty cool, right?
Well, that's exactly what we're going to talk about in our next Wings of Wealth Explainer. We're diving into things called REITs and InvITs. They're an incredible alternative to just stocks and bonds, and they might just change the way you think about investing. You're not going to want to miss it, so stay tuned.
And just a quick reminder, this explainer is for educational purposes only. Any specific products we mentioned were just for illustration. This is not investment advice. Please always make sure to consult a certified financial advisor before making any investment decisions.